Many of you know I've been bearish on the Magnificent Seven stocks for a while, and a lot of them are finally coming down. I did say a lot of them are getting very interesting, and I got a lot of questions on Microsoft because Microsoft is down over 8% with the current decline 10% on the months after earnings or close to 11%. So I got a lot of questions. Is Microsoft a good buying opportunity? What do I think of the earnings and all that kind of stuff? And this is what I'm going to do in this video. I'm going to keep it short as always and give you my buy price on Microsoft, a price where I would be interested in buying it, or pretty much my fair value and what I think of the company in general. And I always keep that stuff very short. A lot of you ask me, you don't do DCFs, you don't do 20 pages of breaking down Microsoft Azure and this and that. I don't do that stuff. I keep it very simple in my own analysis and in what I do on YouTube. And in my experience, most of the good opportunities are somewhat obvious. I mean, you could tell they're getting a good deal. You could tell that everything is fine. And if you make it more complicated, it doesn't mean you're going to be right. So I like to keep it simple. But for Microsoft, it was a good quarter. They did a pretty good beat, 295 versus 293. They also did beat on revenues. So all that stuff was very, very good. And why was the stock going down? Well, CNBC is saying it's mainly because of intelligent cloud, Microsoft Azure and others, and it generated 28.52 in terms of revenues, and the expectations were 28.68. So it was a very slight miss. I mean, it's pretty much nothing. It was a very slight miss. So they grew 29% instead of growing 31%. I mean, big deal. It's 29%. It's still amazing for a $3 trillion company like Microsoft. Microsoft is a stock that always surprised me. I saw many times before that it just peaked, it's getting too big, it can't keep going forever, and it keeps growing 50-60% revenues. I mean, absolutely stunning. At 29% for Azure, which has the second largest in terms of market share, right behind Amazon Web Services, 29% is not bad at all. But the market did overreact. And I believe it overreacted so far pre-market. I don't know what it's going to open at, mainly because the stock was priced to perfection. And if you have any kind of disappointment, you tend to have a massive reversal in the price. And this is what's happening with stocks like Microsoft and others. But it was still pretty decent growth, 29%. Sometimes it grew 29, 26, 27, 31, 35 in terms of Azure and cloud services. So, I mean, it was no big deal. And sometimes it happens, it fluctuates. But CNBC is trying to make a big deal out of it, and I'm not really surprised. But in terms of everything else, they grew 16% in revenues. Again, it just surprised me how it keeps on going. In terms of personal computing, it has been struggling before. Now they grew 50%. So this area is improving. Net income or earnings per share up 11%. I was expecting a little bit more if they bought back some stock, but it was 11%. If you look at the PE ratio, it's now trading around 33 times earnings, which is not too high over the last 5 years. I mean, it was trading this way in 2020, 2021. But if you look at it on before, it's expensive. It used to trade 20, 25 times, even sometimes 18 times. But you have to understand that now Microsoft has higher net income margins than before. It has more opportunities with AI, which I'm not going to discuss AI because I'm not an AI expert and I don't claim to be. And I think it's very hard to know who's going to be the winner and who's going to beat who and what's going to happen. So I just focus on the overall picture. And Microsoft has a lot of things going for it right now, which I believe gives it some kind of a premium. It deserves a premium over what it used to trade at before in terms of 25 and 26 times earnings. It doesn't mean we can't go back there, but I think it's highly, highly unlikely for Microsoft. The company still has a good balance sheet, over $75 billion in cash and cash equivalent. Long-term debt is like $42 billion, but then they have $27 billion of other long-term liabilities. This is my favorite line. A lot of companies been using it, other long-term liability, long-term income taxes, long-term deferred income taxes. And if you break it down, it's like double or triple what the long-term debt actually is. And all of that stuff is debt, which I don't count lease obligations, but most of it is debt. And it has a lot of that. But this is Microsoft. They have a lot of cash to do buybacks and dividends. So nothing to worry about. This is my valuation model or my fair value on Microsoft. I used 15% revenue growth, which I believe is fair and it's in line with the analysts. They have between 14 to 15%. So I put in 15%. That's, I think, is fair. Net income margin right now is 36%. Here it says 28, but I kept it at 36%. It could expand a little bit more, but I wouldn't count on it. So I'm betting on 36%. PE ratio, this is the tricky one. I put it at 30 times earnings, and I put it at 30 times earnings because I want to illustrate a point. I'm not saying Microsoft cannot trade at 25 times earnings, 10 years from now or 5 years from now after this valuation. But I would say 30 times earnings is pretty fair for the growth and for everything else. But I'm trying to illustrate a point. So even if we put up 30 times earnings for Microsoft, a 2% shareholder yield, which is like a 1% dividend, 1% buyback, in total, I'm getting 66% on the upside or 11.3% CAGR. This is with 30 times earnings. Forget 25. This is with 30 times earnings. And if it does trade at 30 times, and if I want to get it double over the next 5 years with Microsoft, I cannot pay more than $330 per share. So I have to pay pretty close to 330 or below for me to get a double or around 50% CAGR on something like Microsoft. The upside from here is only 66%. Now, in terms of $330, I mean, it was trading there. I would say in early 2021, early 2024, it was trading 340, 350. I mean, it could go there. That was trading at 406 and might not go even there. But I wouldn't bet on anything beyond that. I mean, I think that's pretty fair. 15% is fair. 36 net income margin is fair. 30 times earnings is fair. If you use 35 times, which is like, I would never use it. This is like the best case scenario ever. Then you would still have to buy it at a maximum of 381. And now it's trading at 406. So for me personally, Microsoft at this price is still somewhat expensive. It doesn't mean you can't make money with it. It doesn't mean it's not going to go up over the long term, but it's all about on a relative basis. All stocks go up over the long term. I keep getting these comments, I'm buying this company because it's not going anywhere. Well, most companies aren't going anywhere, but it's all about where is this company going relative to other opportunities. And for me personally, relative to other opportunities, and I talked about some of them, Visa and other companies, to me, Microsoft looks overvalued. And I wouldn't pay more than maximum $350 per share if I was dying to buy Microsoft. If not, I would wait for a lower price. If it doesn't come in, I'm fine. I can miss the boat. I don't care. I don't FOMO. I don't overpay. So if it gets to my price, I would buy, Microsoft 330, 350 per share, dollar cost average down. If not, it's fine. And I'm finding better opportunities. So for me, Microsoft is not a buy. It doesn't mean it can't go higher, but I think it's priced to perfection, and that's just what I think about it. And this is my opinion on Microsoft. So thank you for watching the video. I hope you enjoyed it. If you did, please press the like button and maybe consider subscribing. So I'll talk to you in another video.